What is going on, investors? Hopefully you guys are having a great weekend out there. That is right. It is time for the weekend stock show where we're going to talk about all the things that happened last week in the stock market, but more importantly, what is going to happen in the coming week. Now, obviously, the big news last week was you had the Federal Reserve make an announcement that they potentially will have to raise rates a little bit sooner than the market anticipated. That had an impact on interest rates. It had an impact on bank stocks and potentially on the market in general as well. When we get over to the stock chart, especially on the S&P 500, I tell you what, we broke through a trend line that we've been talking about for several weeks here on the program. We'll also talk about the economic data that we're seeing next week. We've also got a preview of earnings as well. We'll talk about the earnings that we'll have next week, but more importantly, in a couple weeks as we roll into earnings season, as we approach July of next month. We've got earnings just a couple weeks away. We'll talk about which ones we can anticipate. And we've got to talk about crypto as well. As usual, above me, we've got a ticker. You can follow along on the topics, but in the description below, I've got timestamps if you want to jump around and get to the topics that you want to get to. You can always do that as well. Let's kick things off with the economic calendar that we've got heading into next week. On Tuesday, you've got existing home sales. Those are actually expected to come in a little bit lighter than the previous month. So you've got maybe a potentially softening of the housing market, which wouldn't necessarily feed into this idea of inflation, okay? When you have inflation, what do people want to do with their money? Do they want to keep it in the bank? Do they want to hold it? No, the value of that money is going down. They would rush out and spend that, maybe potentially on homes. So we're seeing a little bit lightening there. Now, Federal Reserve Chairman Jerome Powell, who we'll talk about on today's show, is scheduled to testify on Tuesday as well. On Wednesday, you got new home sales. Those are expected to tick up. So maybe there's no existing homes for sale. People like me that own a home I sure as heck don't want to sell and get into this buying market, but maybe existing homes, new home sales are surging because home builders are seeing profits there. You got crude inventories coming in on Wednesday as well. On Thursday, you've got core durable good orders. Those are expected to come in a little lower. You've also got a GDP reading on Thursday as well, expected to be pretty hot, about 6.4%. And you got initial job claims on Thursday as well, jobless claims. Those are expected to come in underneath where they were previously as well, which is good for the job market. Now, moving on to upcoming earnings. So we've got earnings next week. We've got Plug Power, which we'll certainly do a video on them. That is on June 22nd. That is 3 days from now. Nike is on the 24th. We'll also do a video on them as well. That is in 5 days. Depending on how you look at it, this is kind of the pre-earning season, or it could be the way you look at it. This is the end of earnings season. Nike and Plug Power kind of closing things off, and then we move into next month, where traditionally bank stocks kind of kick things off. You got JP Morgan in 24 days on July 13th, Goldman Sachs same day, 24 days from now, Bank of America, Wells Fargo, and Citigroup, all the big kind of consumer-facing banks, or a little bit larger consumer business, although JP Morgan's is pretty big as well. That's 25 days from now. You got BlackRock heading in 27 days from now. We'll certainly do videos on all or most of those companies heading into next month, and it'll be really interesting to see the data when we see these banks, see holdings, we'll see loan growth, those types of things. Because as we talk about our main topic on today's show, is the Federal Reserve going to crash the stock market? Okay, it all has to do with the banks and how money is moving through the banks. Okay, I think everybody thinks the definition of inflation is the government printing money. It's not only that. You got to spend the money, okay? You can print money, and if it just sits in a bank, well, that could actually lead to deflation, not inflation. We'll talk about all that here on today's show. Let's jump into the QQQs. I want to look at the SPY and the QQQ, not just one index. We'll look at both. Kick things off. This is the SPY, which is a proxy for the S&P 500. We've talked about on this show where, look, you don't have to do sophisticated technical analysis. When you're on a monster run like this, that trend is intact until it's broken. And take a look. We have a candle here. Now you can push this. I have this line pushed down pretty far. You could push, some people might want to push this line all the way up in here. And then, yeah, we have pretty solid confirmation that we are below this trend line. Now, we've been below it before a couple different times. Okay. And now, so we're looking actually literally Monday or Tuesday, because this is a daily chart. Okay. Over the last, since November, this trend line has been intact, and it has been intact for all but maybe a day or two. So we're looking for the SPY to bounce back, and it would have to bounce back tremendously. Okay, we're looking at a 4 or 5% move on Monday or Tuesday to get this trend back intact. I don't necessarily think that's going to happen. I think our trend is broken here, and now we're looking for areas of support on this one. First area of support really is down here at 405. That's still $5-6 away from where you're at here on the SPY. So we'll see what happens. That could be another 1%, 2% drawdown on this one before you find some footing. Now, the QQQ, which is the NASDAQ, little bit different story, okay? I still think our uptrend is intact on this one, and we still have not broken through. In fact, we're sitting right at all-time highs on this one. So two things can kind of happen. The markets can kind of diverge a little bit, or the QQQs may be a little late to the party, and it is going to get dragged down along with the rest of the market with the SPY. We'll see what happens. Now, one of the reasons why potentially the SPY is down big is the XLF. So this is the financial ETF, which includes JP Morgan, Bank of America, all the banks that we just talked about that report earnings here in about 3 weeks or so. All of these banks, especially JP Morgan and Bank of America, probably the two largest holdings in this. Okay, this is what this ETF basically represents. It's a basket of these financial stocks. Well, that broke trend too as well. Okay, notice we had big red candle, big red down day on this one. Okay, and so one thing that people might be thinking about, well, why the heck are the bank stocks doing bad? Because look, JP Morgan, just the other day, this was on June 14th, which is just 5 days ago, Jamie Dimon was at a conference, and he is obviously the CEO of JP Morgan Bank and one of the most recognized bankers in the world. He says his bank is prepared for higher rates and more inflation during an industry conference. Okay, tell you what, you higher rates, what are those? That's good for banks, right? In fact, here's the 10-year treasury. Look at this. So the 10-year treasury bottomed out down here at 0.57, and that was in August. Okay, now I want to take you back to the XLF. When did this thing kind of see a bottom? Down here, not quite in August. So August is back here, but we noticed that rates bottomed down here in August and started to rise through September, October, November, December, all the way up into March. I want to take you back to the XLF. Look, rates started bottoming and they started growing down here, October, November, December, January, February, March. Okay, the XLF rose right up with interest rates. As interest rates rise, that is good for banks, because how do they make money? They lend money for cars, homes, personal loans, business, all those types of things. And the higher they can charge for that, the more money that they make. Well, look what happened. Interest rates started to roll over the last few weeks. We see that the interest rates kind of peaked out in March. The XLF continued to roll, but now we are seeing a softening of that. Okay, there was kind of a delay to the XLF kind of taking off to interest rates rising. I think you'd expect this thing to delay coming back down as interest rates started to come down. So it's interesting that Jamie Dimon was saying, hey, I'm prepared for higher interest rates. I'm prepared for more inflation. Well, that is because that is good for him. That is good for his business. Okay, it'd be at an investor conference talking up what is good for you and good for your stock is probably a good thing. The reality is interest rates are sliding. Interest rates are coming down, okay? And in fact, they're at a key technical level. I'll zoom in here a little bit. Notice that we are at a key technical level here at 1.4, we'll call that 1.44 or so on this 10-year yield. You break down below this, look, there's some solid red candles here. There's not a lot supporting this to get it all the way down to maybe 1 basis point or so on the 10-year yield. So it looks like to me, interest rates actually want to go lower, which is interesting when we talk about the inflation argument. So the last thing that I wanted to show you here is the XLF, which again is the financial ETF, compared to the S&P 500, which is this orange line. So on this graph, this orange line that you see here, this is the S&P 500. The candlesticks, the red and green candlesticks that I have on here, this is the XLF ETF. And you notice over the last year or a couple years here, this goes back to 2018, so this is several years, highly correlated, right? As the XLF goes up, so does the S&P 500. As the XLF come down, which is the financials, the banks, as that come down, so the S&P 500 comes down. We went up in tandem. We came down in tandem. We went up in tandem. Guess what? XLF coming down could bring the S&P 500 down with it. So we'll see what happens. Technically, the XLF did reach a level of support here. It tagged this area here very close to it. We're not quite on it, but about $35 on this ETF is an area of support and would be a reasonable spot where you'd expect somewhere inside this box, $33 to $35, you'd expect this ETF to find some footing here, if not up above 35. Now, I tell you what, you break 35, you're coming down into these zones as well. The more and more drop you have, this thing could drop like a rock. We'll see what happens. We'll certainly monitor this heading into earnings as well. Now, moving on to our main topic, is the Federal Reserve going to tank the market? Because look what happened on Wednesday. Okay, the Federal Reserve had announcements. Jerome Powell spoke that we got the dot plot of anticipated interest rates. What happened? What happened when they had their announcements? Well, the XLF rolled completely over and basically led the SPY over. This is why I'm talking about how there's a correlation between what the Federal Reserve is doing, certainly what happens to banks, and what happens to banks could potentially draw down the rest of the market as well. So the Federal Reserve had this Wednesday meeting, and I think the big news came out of it is that rates were expected to stay near zero or at zero into at least 2024, which is several years away from now. Now, the majority of federal officials see rising rates just marginally by the end of 2023. So we went into at least 2024 of no rising interest rates. Now they're seeing that rates could potentially be rising by 2023, and that is up just fractionally over the last meeting that they had. So again, you might be asking yourself, well, wait a second. Wouldn't this be good for banks? Wouldn't rising interest rates, just like Jamie Dimon wouldn't go to a conference and say, hey, I'm prepared for higher rates and more inflation. He's saying that because it would be good for his bank, okay? And then also the Federal Reserve kind of backed him up and said, yeah, we were thinking about not raising rates till 2024. Now we're thinking about doing it by the end of 2023. We'll raise them marginally there. So you might ask yourself, well, why the heck are bank stocks really not doing well? Here's the deal. First thing that we talked about on our last show is that the Federal Reserve has this reverse repo program. So in a nutshell, what this is banks like JP Morgan, banks like Bank of America have tons of money. The system just has tons and tons of money sitting on the balance sheet. And certainly when we go through our bank earnings, you can go back and review our earnings that we did 3 months ago on these banks. But the theme of JP Morgan and Bank of America, Wells Fargo, Citigroup, especially the consumer-facing banks, the theme 3 months ago was that loan growth was down at JP Morgan. Loan growth was down at Bank of America, meaning consumers are taking out less loans for things like cars, businesses, homes, all those types of things. That growth across the board was down across all banks. Okay. Now, in contrast, the balance of savers, so think about your checking account, your saving account, that grew, and that grew tremendously, particularly probably because of stimulus checks. Also, think about over the last year. Probably didn't take a vacation, probably didn't, spend money on things that you normally would spend if you could get out in the economy and do your normal type of buying and selling of goods. So we saw an increase of savings, and a decrease of loans out there. And so that particularly hurt the banks, at least in that sector of their business. Now, you might ask yourself, what the heck does any of this have to do with anything? Now, what I want to talk about is, okay, so the banks have all this money on their balance sheet, okay? And there's fewer and fewer consumers coming through the door saying, I want a car loan, I want a business loan, I want a home loan. Believe it or not, that demand for that is actually falling and going down, okay? At least when we last saw that the banks reported earnings, and I actually would anticipate that to continue. Why? Because you have an indication of it here. So this is our reverse repo program, which we talked about on last week's show. So basically what the Federal Reserve is doing is saying, hey, banks, you've got a ton of cash on your balance sheet because of rules that are set in place by Congress. You can't get too big, okay? You can't have too much cash sitting on your balance sheet. Okay, so what the Federal Reserve is doing is saying, hey, we'll take that cash in an overnight loan. We'll take that cash from you and we'll exchange it for treasuries, okay? And so the banks are taking advantage of this, okay? So the banks are sending money to the Federal Reserve in exchange for treasuries in an overnight swap, okay? And that's why it's sometimes referred to as an overnight swap or an overnight loan. In other words, a reverse repo. Now, here's the deal. What a lot of people didn't necessarily notice during the Federal Reserve meeting on Wednesday is they actually agreed to bump that interest rate. So the interest rate on this overnight loan was 0, and banks were taking it at a record number. We're talking about billions and billions of dollars, okay, that banks were swapping funds with the Federal Reserve. Well, guess what the Federal Reserve had to do? They actually decided to bump the interest rate up to it. Okay, so they're now paying the banks. Now the banks can take the cash that's sitting on their balance sheet that consumers are not demanding through loans for cars, homes, and those types of things, at least not at significant levels. And now the bank can take that money and give it to the Federal Reserve in an overnight loan and earn 0.05% instead of 0. So why, you might ask yourself, well, wait a second. So why did the Federal Reserve? They already had record amounts of interest in this reverse repo loan. Now they up the interest rate, which is going to up the demand even more. Okay, it was paying 0. Imagine getting paid $0 for your work, and then all of a sudden, and you were just willing to work for $0 per hour. Okay, you were just pouring your hours into working for $0 per hour. And then your boss said, "Well, no, wait a second, I'm going to pay you $0.05 per hour." Well, you'd probably work even more, right? Same thing is happening with the banks. Now the Fed saw after announcing this rise in interest rates from 0 basically to 0.05, now they saw $756 billion. And a lot of people think it's going to hit $1 trillion, okay? Now what's the significance of this? Okay, banks taking money overnight, loaning it to the Fed, earning 0.05% on the money. You might ask yourself, well, what the heck does this, what does this matter? Okay, what's happening is money is being trapped in that financial system. Okay, when the banks take your deposits and don't loan it to another individual, whether it's through a car loan, whether it's through a business loan, or whatever it is, the economy is not growing. Okay, so when the Fed when Bank of America takes your deposit, takes your paycheck that you leave in there, or your stimulus check or your tax return, and you just leave it in the bank. And then that bank just turns to the Fed and then swaps it for another asset, for an overnight loan, for a small interest rate. Nothing is being created here. No services are being created. When you go out and buy a used car or buy a new car, service is being created. A commission is paid on that. Mercedes-Benz makes money. Tesla makes money. Their chargers make money. The gas station down the street will make money. Whatever it is, there's a long list. When you buy a car, when you buy a house, you'll go to Home Depot, you'll go to Lowe's, you'll take out a new credit card, you'll buy carpet, you'll buy hardwood floors, you'll buy paint. That is how the economy grows, is when you have money moving through the system, the velocity of money, okay? And a more important indicator of inflation is the velocity of money, or the M2 of money. Okay, and now what I want to show you here is this is the M2 of money. I'll even zoom this in a little bit so you can probably see it a little bit better. So this comes from the St. Louis Fed, and this is the velocity of money. Okay, and this goes back to 1960. I want to show you where we're at right now. the velocity of money is in the absolute tank. Okay, here was the last financial crisis we had in 08, 09. It wasn't even close. It was much higher than it is today. And you might ask yourself, well, what the heck? Velocity of money, what the heck is that? Okay, first of all, here's the thing to understand about the velocity of money. Okay, so if for some reason the money velocity declines rapidly during an expansionary monetary policy period, okay, let's take this sentence kind of one by one. Okay, if the money velocity declines rapidly, okay, as you can see here, whoa, rapid decline in money velocity. And why is this? Okay, we just went into a pandemic in 2020. That's kind of where the velocity of money really fell off. Okay, think about why. Okay, you didn't go out and buy a new car. A lot of businesses were closed, all those types of things. It makes sense, right? Okay, we were on lockdown essentially, and not here just in the United States, but globally, things were on lockdown. So you'd expect the velocity of money to go down. Okay, people were spending less, they were traveling less, moving around less, spending and exchanging their dollars far less than they were, obviously, in any time in history. Makes a lot of sense, right? So here's what the Fed says about this, okay? If for some reason the money velocity declines rapidly during an expansionary monetary policy period, okay, have we been expanding the monetary policy over the last year as well? Absolutely. Record number of spending bills, expansion of monetary policy, expansion of money supply. It can offset the increase in money supply and even lead to a deflation instead of inflation. I'm going to read that again. Which is referring to the M2. So the M2 can offset the increase in money supply, which we've seen, okay? I don't need to bring up a news article to show you that the trillions and trillions of dollars that have been spent here in the United States has increased the money supply. But what can offset it? Rapidly declining M2. And in fact, it can lead to deflation instead of inflation. So you can print all this money. You can print all this money that the United States and around the world has printed. And what offsets that is actually people not spending the money. And where do we look to for proof that people are not spending their money? The reverse repo. Because if people were spending the money, if people were knocking on Jamie Dimon's door, if people were knocking on Bank of America's door and say, I want a used car, I want a house, I want to start a business, I want to borrow money, I want to take out a credit card loan. Well, why would the Fed be seeing absolutely record demand for their reverse repo program? Because why would the bank want to just voluntarily take these funds and earn 0.05% when they could go lend it for a house, go lend it for a car? The fact is that demand is just simply not there. And here's a little bit more to back that up. Okay, we had the Empire State Manufacturing Survey. This is just for obviously the Empire State, which is New York, but obviously a critical state. Here's current indicators. So this is the New York Fed. They come out with this survey. I don't know if I'm assuming it's monthly, but here we go. General business conditions down. Okay, does that look like it's inflationary? Okay, new orders down. Okay, does that look inflationary? Probably not. Shipments down. Unfilled orders coming down. Okay, unfilled orders could be inflationary. Okay, we're seeing that come down. Delivery times way up and actually going up. This can lead to inflation, right? Delivery times, delivery things. Inventories down. Okay, now here's more current indicators. Prices paid. This is super inflationary, right? Big spike up in prices paid, but look what's happening. Coming down. Okay, is that inflationary? Not necessarily. Prices received, very much inflationary. Okay, we saw prices received, but that is starting to come down. Number of employees flat, average employees per week flat as well. So what we're seeing, at least in these, again, these are kind of, I don't want to say it's anecdotal. It's very significant data when you're looking from Federal Reserve data from one of the largest economies here in the United States, New York State area, where you're seeing that, yes, you had some temporary price increases, okay, but prices are starting to come down. Prices received are starting to come down. Now, what will happen next month? And maybe this is just temporary and it'll continue to go back up. We'll see what happens. But the overall thing that I want you to take away from this is all this money printing, all this inflation talk that we talked about, it is not moving through the system. Because if it was moving through the system, if all that money that the government printed and handed out to people as checks, if that started moving through the system, well, look, this M2 would be going up, okay? And in fact, it went up a little bit and then it went back down, okay? You'd expect this to come back up at some point, okay? We'll see if it ends up doing that. But for now, not necessarily moving, okay? And this was updated back in May. I know that's a little while ago, about a month ago. We'll see what the next read is on this one. You get a spike up in this one. Again, it counteracts the increase in money supply. So as M2 stays low, it actually counteracts money supply increasing. And in fact, it can lead to deflation, okay? The other thing that is odd that this, look, the Fed telegraphed that they might raise rates. JP Morgan said we're preparing for higher rates. We're preparing for inflation. Well, look what happened to rates after the announcement. They went down. Okay. So we'll see what happens here. Okay. But the Federal Reserve's policy of trapping money in the system, basically what the Federal Reserve is doing is trapping money in the financial system. And that is leading to a low M2, okay? And it is also leading banks to just participate in this repo market rather than lend money in a traditional fashion, which would lead to inflation. So we'll see what happens, but we got to be worried a little bit, okay? We had the XLF pullback big time this week, okay? And that is, again, on the announcement by JP Morgan, hey, I'm expecting higher rates. And the Fed saying, look, we're expecting higher rates sooner than expected. Well, the XLF took that like a load of bricks, okay? And the S&P 500 will come down with it if this trend continues heading into next week. So heading into next week, I'm looking very closely at the XLF. I'm looking very closely at the SPY as well, okay? And seeing if these can find some footing here, see if this is just kind of a flat. When this trend breaks, it doesn't mean that we're crashing. It doesn't mean that we're going to come all the way down and wipe out all these gains. That's not what it means at all. And especially when you combo that with the QQQ, the tech sector, that is at all-time highs, and this chart looks fine to me, okay? Yes, this thing could get rejected next week and we could come down, but no big deal. You come back down to this trend line, retest it like we've had several times over the last several months, 6, 7 months, 8 months, 9 months. No big deal. Come down here and test this and move back up over all-time highs. We'll see if this is able to do that. So I'm not alarmed, I'm not worried, but I'm definitely monitoring things like this graph on the SPY, and I'm certainly monitoring the XLF as well. And I'm questioning the Fed, okay? I'm questioning the data that we're seeing, because what we're seeing from the news media, CNBC, those types of things, is inflation's coming. We've printed all this money. Inflation's coming. Well, first of all, the consumer has to spend that money, and they have to spend it, pretty rapidly. And we're not seeing that, okay? And in fact, the longer that goes, that will create deflation, not inflation, okay? Believe it or not. And the Fed, many of its members still contend that these price increases that we saw were temporary. And we're starting to see this Empire State Manufacturing data. Again, this is not a lot of data to go on, and I wouldn't draw any conclusions from this. But I would say that, look, prices actually came down in the last month. Prices received came down. That is a small indicator, small, but it is an indicator that inflation could actually be temporary and that we could see prices come back down. And certainly the M2 would support that. Certainly the fact that banks are not loaning money because they have all this money sitting on their balance sheet. They have to participate in this Fed repo. And not only that, the Fed had that at 0%. The Fed had the reverse repo at 0%, and they saw record demand. And the bank said, look, we got even more money. We got to get rid of this money. Well, the Fed raised it even more to encourage even more participation in this program. So that's going to trap even more money in the financial system, okay? Because again, why would the banks take the risk of loaning out for a car, loaning out for a mortgage, taking quote unquote risky loans on businesses, anything like that, when they can just come here and just play the tap dance kind of back and forth game with the Fed and earn a little bit of interest? This is going to trap even more money in the financial system. More money that gets trapped in the financial system, the lower this M2 stays, the lower the M2 stays, it offsets an increase in money supply, and that can lead to deflation instead of inflation. So I know this is counterintuitive to what a lot of people are saying, but I think it is worth kind of taking this information in, not drawing any hard conclusions. I want to end this segment by saying I am not drawing any hard conclusions that we're in a deflationary period, not inflation, or that inflation is completely temporary and that it will go away. I'm just saying I am taking information in from the data that we get and seeing there is some evidence that inflation could be temporary. We're also seeing not a lot of evidence that the consumer is willing to pay higher prices. We're seeing it also what we opened up with, existing home sales. If consumers were willing to pay higher prices for homes, why wouldn't they buy even more houses than the month before? Okay, or the previous read on this. Okay, so those are the types of things that I am thinking about. And probably the most important thing is, look, it doesn't matter if rates are going up or down. Look what happened to the XLF. Got absolutely hammered last week. And I tell you what, there's a lot of stocks in this sector, especially if you're overweight tech like I am. Maybe some of you out there are watching, you're overweight energy or you're overweight kind of speculative stocks. You're going to pull down in these stocks. Look, interest rates will go up at some point. Jamie Dimon's going to be right. Interest rates are going to go higher at some point. They will stop trapping money in the system. They will have to loan it out for cars, for homes, and those types of things, and they will make more money on this. So I'd like a buy the dip opportunity in the XLF, Bank of America, JP Morgan, those types of banks. But in the meantime, the farther that goes down, it could drag the SPY down with it, and we could see strength in the QQQ, or it could get dragged down with it as well. Obviously, there's a lot of stocks in the tech sector that I'd like to jump into as well. Now, finally, we'll close things out pretty quickly here. We'll take a look quickly at the crypto charts. They bounced around. Look, if this is how I would be trading, it seems like every week we come on the show, and I've actually been trading these, making very little small trades. When I say I've been trading this thing, I got two kids. I can't sit in front of my computer and monitor this stuff and trade it perfectly. Okay. I've made a couple bucks over the last few weeks trading these ranges. And it seems like every Saturday we come on the show, it's at the bottom of the range and then it ticks up and then it comes back down the next Saturday. So this is worthy. This is why I'm including the cryptos every week. Okay, we're sitting down here, $35,000 on Bitcoin. Again, we're looking at a Bitcoin chart right now. Look, put your stop loss somewhere down here below 33,000 or so, just in case we break this trend. Okay, this trend is intact, or this sideways consolidation, this trading range is intact until it's not. Okay. And so you want to protect yourself just in case it's not, and we break down below this. Okay. But this is a spot where you can buy Bitcoin and trade it up into the $38,000, $39,000, $40,000 range. Look, that's $4,000 or $5,000 on top of Bitcoin. Bitcoin's at 35,000. You go to 39,000. That's a strong move. Okay. That's more than 10%. Okay. And if you can make 10% kind of trading this, I've been a little tighter. I've been making like 6-7%. I've been a little tighter on my trades. Haven't got it right at the bottom. Haven't sold it right at the top. I've been kind of in between these candles and just churning out a little bit of cash. You know, it's free trades, whatever. You know, it's good stuff. Same thing with Dogecoin. Now, what I have noticed with Dogecoin is we broke through what I would, act as pretty hard support here at 30 cents. And so it's at a level where you could step in here at 28. I would put a stop loss very tight underneath that. Okay. Probably 27 cents, 26 cents, but you can play this up. Now, it hasn't had the peaks up like Bitcoin has had. Okay. We really, for this to be kind of a worthy trade, you wanted to peak back up into the mid 30s, the high 30s. That to me, a little bit more risk, obviously, with like an alternative coin or an S coin, as some people refer to the Dogecoin, anything other than Bitcoin and Ethereum for the most part are looked as alternative coins. But there's a trade here. I tell you what, you drop down to 25 cents. 25 cents is the level I'd be interested in. Now, I'd put a pretty short stop underneath that at about 24 cents, but you've got a level here. That's probably what I'd wait for with Dogecoin. I'd wait for a drop down here to see, since we broke through 30 cents, there's a higher probability we come down here at 25. You get here at 25, you can play the pop back up to 30. That's how I'd like to see that one. Now, Ethereum, I haven't been trading. Ethereum, yes, it looks like we've rolled over. We've hit some support here. There's some support a little bit lower. I probably wouldn't get excited about buying this one until you came down here to maybe 2,100. We're sitting at 2,200. It's a spot where you can get it. But look, we've had a high, a lower high, pretty much a lower high. This thing is trending down. It looks like it's rolling over, okay? But you should find some support down here at 21, and you could bounce at that level. 21 should be some level of support. If you break down below 21, it's look out below on this one. You're probably coming down here to 1750, somewhere in that range. So critical week. I'd actually say critical week for cryptos next week. We'll see if they're able to bounce. We'll see if Bitcoin's able to hold this level again. Okay, it's testing this level again. Dogecoin kind of broke through that level. We'll see if it's able to find some support. Ethereum as well, a little bit higher than that. But then again, we talked about the broader markets. The Qs are looking good, but the SPY is looking very weak, and it is led down by the XLF, which is the financial stocks. That is heading lower. You're also looking at interest rates right at a critical level as well, okay? Look, interest rates bounce here. That was proven to be bad, pretty bad for the stock market. Not all stocks, but that was bad, especially for high-levered tech stocks. That was bad. So you could see a reversal here. We'll see what happens, but I am looking very closely at rates next week as well. The 10-year, any of the rates, if they break the level of support that most of them that are sitting at now, that would obviously be very, very bad for the financial stocks, the XLF. And as I showed you on this chart, as XLF comes down, so will the S&P 500. So it's all correlated to a certain degree. Hopefully you guys enjoyed this video. We'll be back again soon with more in the future. Good luck with your investments.